Hey everyone, you know that feeling that the whole world of investing is some kind of complicated exclusive club? Well, this explainer is meant to change that. We're going to break it all down piece by piece. By the time we're done here, you'll have a clear, simple map for your own financial journey. So let's dive in. All right, here's how we're going to tackle this. First, we'll talk about the race against time that your money is already running. Then, we'll open up the investor's toolkit and figure out how to play it safe. We'll even get into the biggest roadblock for most people, our own brains, before we land on a super simple winning strategy. So first up, the race against time. And this is important, because whether you know it or not, every single dollar you have is caught in a tug of war between two massive forces. And really, understanding these two forces is the absolute bedrock of smart investing. So on one side of the coin, you've got inflation. Think of it like a silent thief that just makes your money worth a little less every single year. You know, the cash you have today, it's just not going to buy as much 10 years from now. But on the other side, you have maybe the most powerful force in all of finance, compound interest. This is the engine that can make your money grow, not just a little bit at a time, but exponentially. When you boil it down, compound interest is just beautiful in its simplicity. It's your money making more money. See, the interest you earn then starts earning its own interest, and that creates this incredible snowball effect that can build some serious wealth over time. The key? Getting that snowball rolling as early as you can. So just how powerful are we talking? Well, there's a fantastic little mental shortcut called the Rule of 72. If you want to guess how long it'll take to double your money, just divide the number 72 by whatever your annual return rate is. So let's say you're getting a 7% return. Your money doubles in about 10 years. Pretty cool, right? But if you're only getting 2%, it takes 36 years. This is why even tiny differences in your return rate can have a massive impact in the long run. Okay, so we know why we need to invest, to beat inflation and get that compounding magic working for us. But the next logical question is, what exactly do we invest in? And that brings us to our next section, the investor's toolkit. The first thing you've got to get your head around is the idea of an asset class. The best way to think about it is like the main food groups for a balanced diet, carbs, proteins, fats. Each group plays a different role in your financial health, and you really need a good mix of them to build a strong, resilient portfolio. So, the big three are stocks, bonds, and real assets. When you buy a stock, you're literally buying a tiny piece of ownership in a company, like Apple or Ford. When you buy a bond, you're basically giving a loan to a company or a government, and they pay you back with interest. And then real assets are, well, they're real, tangible things, like a piece of property or gold. And here's the fundamental trade-off in all of investing. It's really simple. Generally, the assets that have the potential for higher returns, like stocks, they also come with higher risk. Bonds, on the other hand, they tend to be a bit more stable. They offer more moderate returns, but also for more moderate risk. This whole relationship between risk and reward, that's the central balancing act of investing. Okay, so we can't get rid of risk completely. So how do we manage it? Well, that leads us to one of the most important concepts in finance, period, diversification. People say it's the closest thing we have to a free lunch in the investing world. This quote just nails it. The only investors who shouldn't diversify are those who are right 100% of the time. And since none of us, not a single one, can predict the future with perfect accuracy, spreading our bets around is the only truly logical strategy. You've heard it a million times. Don't put all your eggs in one basket. Now, here's a really crucial point. Diversification works wonders against a very specific kind of risk. It can protect you from what's called unsystematic risk. That's the danger that one single company or one whole industry just has a terrible year. But what it can't protect you from is systematic risk. That's a big, broad economic crisis that kind of pulls everything down with it. Knowing the difference is absolutely key. Thankfully, you don't have to go out and buy hundreds of individual stocks to get diversified. Modern tools like mutual funds and ETFs or exchange-traded funds do all that heavy lifting for you. They're basically pre-diversified baskets of investments. And honestly, for most beginners, low-cost ETFs are a fantastic and really accessible way to get started. So we've talked about the what's and the how, but now we've got to face the biggest challenge of all, our own psychology. It turns out the greatest threat to a good investment plan is often our own emotional and, let's be honest, irrational brain. This brings us to the fascinating field of behavioral finance. It basically tosses out that old idea that we're all perfectly logical robots when it comes to money.
Instead, it accepts the reality that our minds are full of these little glitches and biases that can lead us to make some pretty disastrous financial choices. Let's just look at 3 of the big ones. First, there's overconfidence, which tricks us into thinking we can outsmart the entire market. Then you have loss aversion, which means we feel the pain of a loss about twice as intensely as the pleasure of an equal gain. This is what causes panic selling. And finally, herding, that primal urge to just follow the crowd, which almost always means buying when prices are high and selling when they're low, the exact opposite of what you should do.
So, if we're up against inflation, market risk, and our own brains, what on earth is the solution? Well, let's pull everything we've learned together into one simple strategy that is backed up by decades and decades of hard data. Okay, get ready for this number because it tells a really powerful story. Over a 15-year stretch, nearly 93% of professional money managers, the experts who get paid to do this for a living, fail to even match the performance of the overall market. They tried to be clever, and they just couldn't do it.
And that wasn't just a fluke. The data shows this incredibly clear trend. The longer the time frame you look at, the worse the odds get for these active managers. The data is just overwhelming. Trying to beat the market is, for almost everyone, a losing game. The house, which in this case is just the market average, almost always wins.
So what happens if you stop trying to beat the market and you just aim to match it? Well, historically, the S&P 500, which is just a big basket of the 500 largest U.S. companies, has returned over 10% per year on average. It turns out, just owning a piece of the whole pie has been an incredibly powerful strategy. And all of this leads us to a simple but really profound conclusion. For most of us, the winning move isn't about picking hot stocks or trying to perfectly time the market. It's about passive investing, consistently buying the entire market through a low-cost, diversified fund, and then just having the discipline to hold on and let it grow for the long haul. So there it is. A simple, disciplined approach grounded in decades of real-world data is the most reliable path to building wealth. This knowledge is powerful, but it's just the start. The map is now in your hands. The only question left is, what's your first step?